Hello, everybody. I've got more tabs open than normal, so bear with me. Um, Actually caught me in the middle of preparing for my Sunday video, but I'm going to record this one uh, really because I'm sifting emails. So my name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective channel, where I help you make your dreams a reality. If you've seen any of my previous videos, you know that I love strategy and targeted strategy. And that awareness is key because I'm going to keep sifting these financial memes, or in this case, an email, using our investment strategies along with some everyday down to earth common sense. This is an unedited videos. This is an unedited video. You get mistakes when I make raw video. And I'm not at my house today, which is why the background is there. I am showing our strategy of using closed-end funds today because we're going to compare an email about a closed-end fund to something else I would recommend. And I am not a financial advisor. I am a financial strategist. I'm a strategist in general. So that I'm not out to slander anybody. I'm just going to compare opinions. I'm interested in separating the good from the bad when it comes to financial advice because none of us want bad advice as we navigate our finances. So normally I would take you to my Pinterest page, but not today. I'm going to take you to my email and let you read this. And if you wanted to read the article, you can find it on their website or search it for free, but I'm not going to take you and hit read for free. But I do get the free emails from this company because honestly, I pay for another service that I've talked about. And we're going to look at this closed-end fund based on our system, and that's the CEF Master. So I just updated this. I'm prepping for a video this weekend. So of the closed-end fund master, I find it interesting the SABA funds remain off the list. So there are 419, because there are two more that aren't here, 419 current closed-end funds. The current yield average is well above 8, especially with the dip we've seen. And normally I update purple, dark blue, green, and light blue every week. And then I update the entire system every month. And then I go back through and I sift the data again. I look at discounts, I look at targets. Who knows, some random person sending me an email. And then this is how I scale the targets. Triple asterisk is a buy alert. Means the existing discount is double the historical and double the 5-year discount average. If it's a newer fund, there's a little grace there. BRW is a newer fund in that it's an older fund that was bought out. So there's a little more grace in how that discount is compared to the historical data. 2 is a dollar cost average alert based on what we already own, and 1 is tracking. And the 2 blues, we own this in a Roth retirement account, and then we own this in a individual brokerage account. So normally, if I'm making a closed-end fund video, like on the weekends for the coming investment week, I take you through how I sift the data. And you'll see a little bit of that on this video because I'm just going to tack it onto that page. But we specifically want to look at the fund they recommended, PHK. And then I'm going to compare that to a fund we already own. So this is PHK. And let me compare some things. So if we scale dividend, or if we scale the discount for this single fund, every dollar you invest, you're paying $1 when you invest in the company. Versus this company, it sells at a premium. So it's worth more than what it actually is. So for every single time you invest in this company, you're paying $1.65. Or say for every dollar you invest, it's really costing you $1.65. And on the flip side of that, we have this one, which is almost 54 cents off. So it's almost like paying 56 cents for every dollar invested. Now, who doesn't like a discount? But not every discount is the same. There are some funds that stay on discount. The goal is that we find a fund that's on discount, right? Like no one wants to pay full price. So we find a fund on discount, but we want a fund that has a track record of closing the discount. And if you're unlike us, we're structuring our portfolio to pay dividends. We want stock value to improve, but we also want consistent and rising dividends. We want to supplement or fund our retirement using dividends. But there are a lot of people out there that still stick by selling their stocks whenever they retire. So if you have $1 million invested and you're going to go by that crazy 4% rule, then 4% a year you're selling off. You're hoping that the market gains about 4% a year, so you break even. But that's only 40 grand. You can't live on 40 grand right now. You're not going to live on 40 grand later. And inflation's always going to go up and devalue your money. So your money is being devalued every year. Your cost of living is going up every year. By the time you retire, 40% ain't going to cover it. And you're selling your stocks. So if we can maintain our principal and then live off the dividends or supplement with the dividends, that's a much better deal than selling off the overall portfolio. So just because there's a crazy discount doesn't mean it's an actual crazy discount. And that's where the target system comes in. So if we look at targets and we compare the existing discount for just this fund, some random text again, notification, but if we compare the existing discount to the historical discount for the fund, then we end up with a target. And is the existing discount better than the historical or the 5-year average? And the target system is both. It has to be both. Now, there's some leeway for newer companies because their historical data is not as diverse as a longer standing company. But this, you'll find the existing discount, 12% off, 88 cents for every dollar invested. That's great. But the existing discount doesn't meet the metrics. It's better than the 5-year discount, but it's not better than the historical discount. So it's got to be both. So if we look at just PHK, sub $5 on the per share, that's great. Pays an almost 12% dividend, that's great. But there is no discount, and our focus is we don't pay premium. Like there's a list of things we look at when it comes to our code of investing in closed-end funds, but we don't pay premium. So I get it. 4 cents is not a huge thing. So for every dollar invested, you're really buying it for $1.04. That's great. But that's not a good deal. So if we look at this company, based on where I generally get the data for that closed-end fund master, you can see the overall track record of the fund. Since COVID hasn't really come back, that kind of mirrors the rate market. I get it. You can look at overall distributions, pretty consistent. All right, we can look at the overall pricing information. Generally sits premium. Right now, we're buying at a discount compared to what the premium normally is, but it's still a premium. It'll tell you the top 10 of the portfolio as of March. If you really want to dig through the company records, you can find more data. Morningstar's got a little bit more data. And make sure somebody's not trying to find me. Yes, somebody is trying to find me. Let me answer a quick. I hate doing this by video, but my kid's trying to find me. All right, so we can get a general breakdown for the overall fund between equity investments, fixed income, where that breaks out to, overall size of the company. And I want to compare it to a company we already own. This is my work for this week on what I'm going to suggest for like a shortened buy list for next week's investment cycle. So this is what was recommended. This is my counter. It's a little bit more per share. You're getting a comparable dividend. You're getting a better sized dividend, but you're also getting it on discount. And how that works in general is it's a pretty new fund with a closing overall window on price. The overall valuation of the company has gone up. That's what we want to see. But the window between what the discount is and what the overall value is has closed significantly. Distributions. Besides the 1 month, like they started out, current rate market, they've slowly increased the dividend. See the pricing, mirror that image on the first page. There's no portfolio info because it's still really new. And Morningstar still doesn't have the portfolio info up, but we still get a snapshot of the company. Crazy high fixed income, which works well for longer better, or higher for longer, I guess you could say. Higher interest rates, even if they drop at 2-3 rate cuts for the year, and in the next year that's still higher for longer, works well for us. It also gives you a breakdown, well, where the general category is. It doesn't have this. That's where my research comes in. So it's actually about $2 billion in assets now, which is close to their $1 billion, but still a difference. But about $2 billion assets, private lender, corporate bonds, all American, so not a global market. I like that in some regards. And then you get this really high fixed income percentage, which is great on that higher for longer rate. And with our system of funds, you can type in how many shares you want to buy. It'll calculate it. It'll tell you what. So the dividend. So you get the dividend of period. You get the annual dividend. You get the overall yield. And then it'll also tell you, like from my standpoint, if it hits the metric or not. We don't consider anything outside of a triple asterisk. So kind of breaking down emails and also using our system to compare the data. So hopefully that helps. I'm not dogging Seeking Alpha. I mean, I don't want to seem like I'm dogging Seeking Alpha, but we're looking at the same data. Quite honestly, they present a lot more data than I do, but we're looking at similar data, but we're looking at closed-end funds through a different lens. There's a ton of people that see the dividend, and there are not many people that see the real difference between buying in premium and then buying discount. And then there's an even smaller group of us who really factor out and sift through the discount to see if it's worthwhile or not. Because something that's always discounted isn't necessarily a good deal. You get a killer discount, but that window and that dividend are never going to change. Versus PHK seems to be always in premium, so you can get it for a cheaper premium, but it's always going to be premium. And for us, we don't buy premium. So if you like the content, consider subscribing to my channel, hit the like button, and then head over to Facebook and check out my group there called Navigate Your Finances. Remember, you're the captain. You get to make your decision. So if your strategy is buying a fund that has a cheaper premium now, knowing that it's going to scale up, and that either you can sell it or leverage it into something else, that's fine, because that's your strategy. But you have to know your strategy. So whatever you have for the week, I hope it goes well. And if you don't know your strategy, and if you need some help with strategy, then either check out some of my other videos, comment on a video, or come find me on Facebook. So whatever you have, I hope it goes well. And just know, whatever you're trying to find, whatever you're looking for, it's not going to happen unless you make it happen. So think about it, plan your strategy, and then make it happen. See y'all later. Bye-bye.